Hello, everyone, and thank you for listening. Me and Andrew, we're quite excited about today. We have Francelle, head of, what is exactly your title? Here you go, I have it here. Head of Structured Retail Products at Salem Financial Markets in South Africa. And thank you, Francelle, for coming to the podcast and talking with us.
Thank you very much, and thanks for having me.
I think this is very, very interesting. And me and Andy were talking about doing more about insurance, because most people think about structured products as the notes, as securities, but in reality, right, because structured products are multiple financial instruments together, there is a massive market of insurance structured products or investment products across the world, from the US, from Europe, from Japan, and of course South Africa too. So Francelle, can you tell us more on how the structured products are used in insurance in South Africa?
Yes. So, the structure that's, of course, used is to wrap the underlying bank-issued note in what we will call an endowment or a sinking fund. I guess there's different terminology used across the globe, but the basic principle is that this will be issued as a discretionary investment solution. So it doesn't form part, of course, of your compulsory savings, either pre or post-retirement. It's a completely discretionary solution. And because also it has a fixed term, these products are used as investment options in larger portfolios that clients will structure. But having it in the wrapper does actually allow some interesting possibilities for the structuring, both on roll, both on the tax treatment. There's some quite a few nice levers that can be pulled. And then how it would be used is as a discretionary investment option. And clients would very often compare this to the vanilla 5-year fixed return, which is a very, very commonly used, almost we call it the bread and butter product that many of the life insurers, of course, will focus on.
Why do you think these products are getting traction? And it's not only in South Africa, it's everywhere, in the US, in Germany, in Japan. Is it just the tax? Or what are the other advantages that people are looking at these products saying, yes, it makes sense?
So I think there are mainly two reasons. The one is increased client sophistication. I think in the South African market, as I said, traditionally a fixed return product would have been sold. Of course, it's mostly to a slightly older demographic, but it's still unbelievably popular. But as the market becomes more sophisticated, we've seen more and more queries coming for these products, also via the sales force. So there's definitely the educational aspect and increased client sophistication. But I think the other reality is, regardless of what's going on in the globe, and we don't need to dwell on that, but we are still generally in a declining rate environment, and people are looking for yield. So they are able to kind of expand their risk hurdles a little bit and get themselves comfortable with something that, has a few extra risk parameters, but then can offer them a better return.
Do you feel like regulation as well is helping out with the demand for it in South Africa?
No. So I'll be honest, the regulatory environment has been fairly stable, and the regulations around these endowments and, so in our environment, it's called linked policies. So the risks and the rewards are passed on to the client in its entirety, even though the asset is held on the life company's balance sheet. But besides the fact that there are regulatory limitations on surrenders and then having potentially early liquidations, but there are other ways and means around that. But besides that, luckily, that has been fairly stable.
It's interesting, right? Because you talked about the benefits, not only tax, but also how people are looking for yield, right? But in insurance, the typical insurance is always fixed rate. You know exactly what you're going to get invested in bonds, right? That's what is the insurance world, right?
Absolutely.
Do you think that these products are misunderstood or not used enough by investors?
So definitely, I would perhaps not go as far as saying misunderstood, but there's definitely, even though the sophistication has increased, there's still a lot of work that could be done to explain the benefits.
Mm-hmm.
Just also to confirm, the products won't be used to hedge your life insurer's typical annuity books and those products with longevity risk. I mean, there you will, of course, have a completely different type of asset liability matching strategy that is still fairly traditional. So this would be a discretionary investment solution where the client decides, that they want to add this to a well-diversified portfolio. The one thing that we have seen, of course, is where outcomes go against you.
Yeah.
Where, no one, unfortunately, of course, is promising that, rewards will be obtained and that indices will end where you want them to end. And I think that is where we are actually doing quite a bit of work, because despite the fact that, there's clear communication and of course there are strict rules around how communication is done,
Mm-hmm.
your typical TCF, treating customers fairly is of course quite important.
Yeah.
But however, clients are still not happy when they only get capital back.
Yeah.
So I think that is actually something, I think, in the insurer space where the insurer is not guaranteeing the outcome.
Yeah.
There is definitely other factors
Yeah.
at play.
I think this is quite interesting, right? Because I was having conversation with an insurance company in the US, and they were, again, most of them do life insurance structured products. And of course their main focus, the way they pitch it is rates are lower, equity markets are the way to get that extra return with, of course,
Yes.
there is no guarantee on returns with equity
Yes.
markets, or actually even with bonds, right?
Yes.
It's not always guaranteed. How do you see the type of products for South African investors, and how are you as Salem? What are the products within the structured products that you think are working, and how are you using them with yeah?
Yes. Yes. No, so that is a very good question. I mean, what we are seeing is demand for capital protection is still the overarching investment goal.
Mm-hmm.
There's a very low appetite from the investor base, even as you move up into your middle to upper to higher income markets. People really want that capital protection. Again, even though, as we said, it will be dependent on the underlying bank. But the defined benefit, or what we'll call in the options terminology as the digital options, I think those work still particularly well. I
Mm-hmm.
know it sounds so boring. I mean, it's been around forever and a
Yeah.
day, but it remains extremely popular. We have, of course, we've done a lot of your participation enhances, some capped, some uncapped,
Yeah.
but we're seeing almost a bit of a turn back to
Yeah.
wanting that defined benefit payout. So
Yeah.
those work particularly well.
And especially, right, because on the sideways market, right, you only need underlying to be just slightly above.
Exactly. That binary payoff, even from a sales perspective, it still remains such an easy conversation to have with a client.
Yeah, yeah.
As you say, there doesn't need to be a strong conviction on a size of a bull run.
Mm-hmm.
You can literally just have any upwards move.
Yeah, I think it's interesting. I think the big thing for me is how do you kind of strike that balance between protection and the potential returns on an upside? Obviously, it can be difficult to weigh up either side. For the retail space, how are you doing that at the moment?
Yes. So we, of course, do quite a bit of work on the underlying indices. So we do try and use indices that, of course, have been designed to price particularly well.
Mm-hmm.
And the other aspect is to, obviously, you can add a bit of layered credit risk on the protection side. So again, similar to quite a few other offerings that are available, we'll offer either additional bank risk or we'll add some sovereign risk. So all those aspects then allow you to just boost your potential option spend and then get a better outcome.
Yeah, it makes total sense. I think it's interesting how you're designing your products to beat the vanilla fixed offerings, the bread and butter you were talking about earlier. Are you doing anything special kind of
Yes.
in that space to push yourself against the bread and butter and try and push yourself further ahead of it?
Yes. So there is luckily a bit of a difference though in the target market. It's
Mhm.
not exactly the same market in the sense that you'll be cannibalizing your own product. The structured products will definitely be an investor with a higher risk appetite. But there does become a point where there will be decisions made between allocations between the two. So I think it actually works quite well in a blended approach. And I think we are also taking that, that stance more and more to say it's not either or. There is a space for both. And even sometimes combining the structured product with a fixed payoff and, of course, no income stream during the life with another annuity product. So you almost create something artificially in a life wrapper that does have that structured product payoff, but it can provide some income. And I think that is again where the wrapper becomes really quite, and maybe innovative isn't the right word, but it's a very convenient solution to then have these multiple offerings.
So that comes to a question that I think it's important for listeners to understand how you, as an insurance company, match these products with maturities or with I think you're only offering products with a certain maturity, right? With the
Yes.
payoffs, and what type of payoffs profiles you mentioned digital, but how do you match that as an insurance company, not being an investment bank?
Yes. So the benefit of the structure of having the linked endowments
Mhm.
does actually allow us to pass on exactly the same risk and return profile. So the asset purchased will exactly match the risk and returns that are offered to the client.
Mhm.
So the life company actually does not need to hold any additional capital requirements. It's a very specific type of policy that is then elected as the vehicle of choice. But you do raise an interesting point, which is something that we are doing some work on, where you could offer it as market related or other types of policies, where depending on the risk appetite that you can kind of convince your actuarial divisions to kind of get their heads around, there could be opportunities, to have some mismatches. But I think at the moment, and I think it's the same for other life insurers in the South African market that offer these, it will be a simple pass-through. So the asset and the liability are perfectly matched. And the 5-year term, of course, is the popular vehicle of choice.
Sure. Yeah, I think when you're going to these with the retail investors and people on the street, the headline benefit for this, are you seeing it as the capital protection, or are you pushing the return you can make on your upside exposure, which is kind of the big one that people are coming in for over the other?
Yes, yes. So initially, the capital protection, I think, it was a big draw card. That was really for people something to kind of, it was
It
new.
changes.
It was like, oh wow, I can get capital protection on equities, and it's all wrapped for me in a very nice, elegant one-stop solution. But now I guess it's almost taken for
Yeah.
granted. Like all products will have the capital protection. So it's exactly as you mentioned. The sales pitch will now focus quite a bit more on the returns. And that actually speaks to the educational component again, and your sophistication of your client, because it's your typical behavioral finance situation where people's pricing expectations get anchored
Yeah.
visually at certain levels. You can try and explain sometimes to a retail client how interest rate cycles have worked against them. Sometimes it works, sometimes it doesn't. People want certain returns. And that is when we start seeing how we can improve the structures to try get up to other levels and to historic levels.
One of the things, right, that investors have an issue and they there's always a topic, although the solution for that is, of course, liquidity, right? If they need, especially on insurance, how does the liquidity work on an insurance product like this?
Yeah. So that is maybe where, again, there is a somewhat of an advantage of using the wrapper issued by the life insurance company. And I see Drew is
Yeah.
frowning. I know it sounds
Interesting.
counterintuitive,
Yeah.
but you are dealing with quite a large balance sheet.
Mm-hmm.
So we are able to actually provide limited funding against the structured product. Sometimes we'll even use, internal funding sources, to actually help meet liquidity requirements.
Uh-huh.
And of course, the insurance regulations will allow one withdrawal that can be a full withdrawal during the lifetime. But then the preferred method is what I mentioned earlier, is where you actually combine the structured product with an annuity
Mm-hmm.
in your portfolio. So I think the point that I'm trying to make is where the banks, of course, if you're the issuer and you have a listed note, you have the concept of the market maker. So while the life insurer can't have that same capability of being a market maker in a note, it
Mm-hmm.
does have other ways and means at its disposal, either combining it with income generating products or then offering additional liquidity, which I think is easier for a life company to do than a bank, again, due to the regulatory environment being different.
Of course, talking about liquidity, and in South Africa, we can't not talk about currency, right? Because it's always a risk, especially with inflation. The average insurance is usually in the South African rand or is in US dollars or other currencies. And
Yes.
how do you see currencies and inflation, right? Inflation and high rates working and impacting these products?
Yes. No, that's very, very valid. I think the conversations around where the rand is trading is almost like, dinner conversation talk
Yeah.
in our market. We're so used to having quite extreme volatility in the currency. So there the regulations are quite strict.
Okay.
So if we issue a rand or the local currency denominated policy, we will hedge with a rand denominated note.
Mm-hmm.
So there's quite a bit of Quanto ZAR notes that we'll access. However, Sanlam Life is one of the few life companies in South Africa that also has a dollar life license. And we have done that. We've offered dollar structured products via the dollar life wrapper again. So then there will be the match of the dollar liability with the dollar asset. We are technically allowed to have some mismatches, but that will result in additional capital requirements, which we'll likely hedge. So at the moment, the issue is almost avoided, by matching the currencies. But we are also constantly looking at that, to see if that still makes sense and trying to grow the book on the dollar side as well.
Yeah, of course, and I was looking at the data and the number of structured products securitized is just exploding globally. Just in Europe, investment products close to 1 million. And if include the leverage product, talking more than 4 million products just in Europe, right? With similar numbers in Asia, then slightly less, but growing. But part of that growth is bespoke products. Is like the average size investors be able to create their own products. How do you see this working? Be able to offering be more bespoke insurance products, or do you think that's something that we won't see?
That is actually something that's been top of mind for me over the past 2-3 years. It's also striking that balance between offering a wide variety and the capability to go bespoke in quite small size versus the effort, almost if you do that cost benefit analysis versus having almost this big bang approach. And I think, some of our competitors are very successful with that, where, we have one large offering and, it is available. And if you don't like it, you can look at other offerings from other providers, but there's not a lot of bespoke structuring always, that is happening. So we followed a blended approach. We have done some quite bespoke offerings for some of our wealth managers in the local market, where you'll work quite closely with the house view, trying to get a sense of what is needed. And I still feel it has a place. I actually also almost don't want to give that up because it does give you access to a part of the market that you wouldn't otherwise access via those huge distribution machines, if you can call it that just, churn out, vast volumes of repeat offerings or, that model. But I guess on the other hand, you do have to, make your targets.
Yeah.
So I would say definitely have your larger offerings that just go out there almost off the shelf, but then almost supplement that with some of the bespoke offerings. It is a big positive, though, I think, that I've seen happening over the past, say, 10 years that I've been involved in this market is the reduction in minimum nominals traded. I mean, it just offers a lot more flexibility, I think, as the banks have been able to accommodate smaller sizes on the issuance.
One thing that's constantly asked to me whenever I meet people, because of the look I have and the beard, is ESG. And I wonder how you kind of use, the portfolios that you build to embed ESG or alternative asset kind of exposure. It's a different kind of world that I'm used to. How are you doing that, or are you doing that at all?
Yes. So we actually quite passionate. And I think if you were to look at the Sanlam Group, like the strategic objectives, there's a big focus on the sustainability and, impact as an overarching investment theme. And I think we're quite early on adopting this. We launched what we call the Glacier Sustainable World Enhancer about 7 years ago, where we used an index that was specifically focused on companies that adhere to the UN Sustainable Development Goals. And we even took it a step further, where we worked with a product provider that had a project in the Eastern Cape, where a portion of the investment proceeds actually went to rehabilitating a forest region.
Okay.
Like there was literally building a tree, planting a tree. And that was very, very successful. I think, we sold more than 15 tranches of that. After that, I think similar as with the rest of the globe, again, ESG almost became an accepted norm, that you expect there to be. Of course, governance goes without saying. Again, in our environment, it's still extremely topical, because it does not always, or it cannot always simply be assumed. But the environmental angle is very, very strong. So we continue looking for ESG indices. There, of course, we'll work with the banks that launch the thematics. But those have proven to be very popular. And I think it suits our investor base well. I think the investor base is quite attuned to environmental needs. Maybe it's just the way the society kind of, looks after some of the, let's call it the natural assets. So I was very happy with that solution.
I think as the retail market obviously expands, we're going to have people with kind of different palettes coming in. So people are going to be pushing into that kind of environmental side more aggressively now and in the future, I can see.
Exactly. And I mean, I'm quite sure we're soon going to be in the debate with, the energy requirements for data centers, I mean, which is already very topical. The whole rare earths debate.
Yeah.
Getting those out, the carbon credits, where that will end. Yeah. So I think, as you say, it's definitely not gone.
No, definitely not.
It's definitely not.
So, I have a question. Now, of course, there is, let's say, contrarian views and provocative opinions on structured products as well as insurance companies, and could heavy reliance on structured products mask tail risk or misprice of long-term liabilities for insurance?
So yeah, that I can see where that view could emanate from. I think luckily in our space, because we are limited to the 5-year term, maybe first looking at the insurers own balance sheet, there won't be additional risks masked or, hidden or unwanted risks retained. And that is supported, in a sense, by the capital treatment that clearly states that, if you are passing on the risks, that you don't need to hold any additional onerous capital requirements. You could argue for some of the investors that because the payoff profile is, of course, very attractively explained in simple language, which is a benefit, I guess, and can have some side effects. Evaluations, I guess, start going a bit, haywire. But I would say that can be dealt with clear communication and education of your distribution force. But yes, and there's also the fact of the matter that you simply cannot, explain certain things in the level of detail required. And again, if you look at the distribution requirements, again, looking at the regulations, explaining and being able to sell the policy has a lower license category requirement, of course, than the structured notes would have. I think that's similar to the other environments. But it's very true. I mean, it's always something to look out for and make sure that there's not misrepresentation.
Yeah. Now, you mentioned something which, of course, is key, which is distribution. So if you had a magic wand, what would you change on the distribution of this? Let's imagine your products, but let's say just in generally speak on the insurance structured products.
Yeah, I guess more is always better. So I think personally in our environment, in the Sanlam environment, we do have a very, very good and a widely, spaced distribution force. So I think the only thing really that you want to change there is just to continuously improve communication and the education. Unfortunately, I think there isn't one, magic solution that will fix it. But I think it's never resting on your laurels, just always making sure that ongoing communication is key. Explanations are being done consistently and clear. Keep your distribution force happy. Keep your advisors happy so that the clients can be happy and that they can ensure that they get the best outcomes.
So you're talking about education there. I'm sure you have a lot of conversations with clients. Are there any questions that are asked to you a lot on any myths that you want to bust about the kind of structured product space?
My personal favorite is I'm losing my dividends. And I think that maybe also speaks to sometimes the mentality of, let's say, if I may generalize a little bit, some of the older investors, there are, of course, people that are your classic long-only single stock investors. And some of them are really hard to convince, to diversify a bit and put some of the eggs in their basket in the structured product space. So I think that has been some of the hardest conversations. Is trying to explain how the dividends are being used in the product and having to explain the decrement indices. But we've come a long way. But yeah, I would say that has been some of the hardest conversation. If someone's thinking in a dividend yield term, and you kind of have to say, look, it's an alternative asset class. You cannot be comparing it to your long only equity.
Of course. Francelle, it's been great having you. Thank you so much for answering our questions. I felt we grilled you a little bit there, but you've definitely.
Good.
Is there anything else you want to bring up before we close up the conversation?
No, just thank you for the opportunity, and hope to keep this conversation going. I think we're all passionate about the market and wanting to grow the market, and in a sense, getting better outcomes for clients, which I guess is a noble goal, and that we're all striving for whilst building our businesses. So yes, thank you for the opportunity.
Wonderful. Thank you so much for coming on.
Thank you, Francelle.